Okay, hello everybody. Today we're going to build the WACC, the weighted average cost of capital, and the cost of equity for Lululemon. We're going to do it in two stages and across two sheets. So we'll put the WACC onto this page, and then we'll put onto sheet two the cost of equity, where we're going to break down. Obviously, we have the risk-free rate, which will be the US 10-year. We'll then have the bottom-up beta, which we'll calculate, and the equity risk premium, where we have the breakdown of the revenues for the first 2 quarters of this year for Lululemon, and we can calculate an equity risk premium from there. As you can see, most of the revenues are coming from the US. Canada's a significant chunk. Then Mexico, and that completes the Americas. And then you have mainland China, and then Hong Kong, Taiwan, Macau, and then other geographic areas. So without further ado, let's get going. We're going to start with the WACC, and as always, open a new spreadsheet, go straight to page layout. We take the grid lines off, we go view, we freeze this. Actually, we don't really need it for we don't really need it for the WACC, so don't do that just yet. Let's make this a bit smaller, the A, and let's put Lulu, type Lulu there. We write that, then we go data, stocks, it's coming. It's this one, the one listed on the NASDAQ. And what we need to do is, so what is the WACC? Okay, so the WACC equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt times 1 minus the tax rate. And the components we need from this, so we're going to go market cap, then we need cost of equity, and we're going to put the components of the cost of equity here. Make this B column a bit wider. Risk-free rate, we want the beta. Cost of equity risk premium. Then here we want percentage, we want debt, percentage of debt, cost of debt, tax rate, total. I think that's it. And when you get the market cap from using Excel, always divide by 1,000,000, because obviously the market cap is in billions, and we want to show it like this. So this is the market cap of Lululemon is nearly $21 billion, but to save space, we get rid of the 6 zeros. Yeah, okay, so I mean, we can find out the debt actually. Let's get onto the balance sheet. Remember this page, page 19. Here we are. Okay, so we want to look at current liabilities. Oh, why can't they just call it debt? To be honest, it doesn't look like it has any debt. Yeah, I think if from this, we really just go current lease liabilities and non-current lease liabilities. So that would be equals. So just to let you know, normally financial statements are done in millions. If you're looking at Apple, Nvidia, Google, etc., they'll report with these numbers in millions, but this one is in thousands. So this is 373 million. Yeah, but you've just got to be a bit aware of that going forward, especially when you're looking at a smaller company like Lululemon, which has a market cap of just under $21 billion. So with this, we put it as 297.919 because we're doing our own spreadsheet in millions rather than in thousands. What's this? 1464.799. 1464.799. Perfect. There we go. Which means the total is the sum. There we go. And so, I missed out the percentage of equity. This equals be a percentage. There we go. Now, the cost of debt, the way we would do this is, okay, we can actually find it down here. We'll also do income tax as well. Keep going. Oh, okay. Income tax. So the effective tax rate is 30.5%. Actually, you know what? We'll just go on to the income statement at the top, and we can see. Okay, here we are. Where's financing? You know what? I don't think. Yeah, you know what? Let's put it. Really, they have zero debt. So this is 100% equity. Really, yes. So the cost of equity is going to be the WACC. Let's start building that out. As always, page layout, grid lines, view. This one do we need to? No, I don't think we do. But it's always nice to do this. Let's, okay, put a next there, put center it. Can zoom in a bit. The first one is there we go, cost of equity. We put cost of equity here, sorry. We go risk-free rate, beta, equity risk premium. Okay, looks good. Let's start with the easy one, the risk-free rate. And we'll call that the US 10-year. Which is 4.174%. C14. And the cost of equity, as we've, for those of you watching for the first time, the cost of equity equals the risk-free rate plus the beta multiplied by the equity risk premium. So I'll leave that there for now, but that's what we're going to, that's what we're working towards. So what's the next one? The beta. For that we need industry. Then so yes, it's going to be, so we want industry. This is, we have a list here, and we go with, let's go with apparel, and I'd probably say, you know, they're in e-commerce. I mean, yeah, it's going to be apparel. And what we want to see is, sorry, 1 second. And we want sample size, the unlevered beta for that specific industry, what would you call it, category? Revenues, EV to sales, value, proportion. And we want the weighted beta. And that's what we need, that's all we need. So, apparel, sample size is 37. That means there's 30, I mean, if you look here, that's 37. There's 37 companies that's been done to calculate the unlevered beta for that category. So it's 0.74. 0.74, and then we need to come back to the revenues. What did I say it was? Page 19 is where we want to be. I mean, unless you look at it this way, accessories and other categories, I mean, it's all within the same. Yeah, I mean, that's not, so we're looking at this for the first 2 quarters. They did nearly 5 billion in revenue. 4895.879. Let's make it look nice. Then the EV to sales. We look on this spreadsheet. I want to take, okay, select all, and we just want apparel. Where is it? Okay, price to sales, we want EV to sales 1.41. So the value of that based on its revenue and the EV to sales is nearly 7 billion. And it would be 100, meaning the weighted beta. Ideally, we would have had more categories in this. I thought there would be something e-commerce based or something like that, rather than it just being solely apparel. But yeah. Now let's go into the equity risk premium. This will be a bit more exciting. So we have US. We're going to follow on these. US, Canada, Mexico. We'll call these North America. The border. Need it a bit longer. So 2025, weight, ERP, and then the weighted ERP. It's better, okay. So US, again, we're getting the first 2 quarters. So we go 277.526. It's because all we're doing, we're just trying to work out where Lululemon generates its revenue from and what the risks to those cash flows are. Mexico 41.136. Wow, they do more than 1 billion in men's. Nearly a quarter of revenue comes from men's. Yeah, that's quite a bit. It's not bad. And the weight equals. Lock this in. I want 2 decimal places. Okay. Now this should equal 1. Yes. Now the ERP for each of these countries, how we do this now is we go, let me see if I've still got it. We use this spreadsheet and we can put in the country that we want to look at. So for this one, we want the United States. That's 4.62%. So we go 4.62%. Then we want Canada. And we get 4.21%. Before, the US and Canada used to be the same, but since the US's credit rating got lowered from AAA to AA, it does have a bit of a default risk, which is why it's now changed. It used to always be the same as Canada, and you'll see Canada is seen as having no default risk, but the US does. Okay, well, let's look at Mexico now. Mexico, 7.03%. Now we take the weight multiplied by the ERP, and that's, ooh, is this right? That's what we need. Then so the equity, the equity risk premium for the North America segment is, one second, let me just get back to it, is this 4.58%. Now we have to do exactly the same for China. Hong Kong. So we'll go HK, Taiwan, and Macau. Delete that one. We call why is it doing that? 0.82. I lock that in, I can just, yeah, all good. So China, where's my spreadsheet gone again? That's where it is. 5.25%. Then, okay, now let's have a look at Hong Kong. Okay, 5.1. Let's remember that, because if they're the same, we'll just get near 5.1 for Taiwan. And Macau, would that even be, have its own? It does. 5.1. Perfect. We don't have to do any work. Yeah, that looks good. Now, what do we do? Other geographic areas. This, they've said, is APAC and then EMEA, Europe, Middle East, and Africa. So we can just, yeah, here it is. The company reports 3 segments: Americas, China, mainland, and rest of the world, which is comprised of its non-significant operating segments APAC and EMEA, reported on a combined basis. So 6, 10 other geographical areas. And what's good about this spreadsheet is we go to regional weighted averages, and at the bottom here, we can get the, and it's a weighted one, so it's done by population or spending power. I'm not sure which one, how he's done it. But what we want, yeah, what we want here is small Asia, the 7.2%, and this one. Let's see. I think they have a bit of a store breakdown as well. Remember to, I need to come back to page 19. Don't let me forget that. Okay, here's the number of stores operated by market. Okay, so in APAC, they have 109 stores. Europe, it's 49. The Middle East, So it's pretty much 50-50. But let's call it 0.55 for APAC and 0.45 for EMEA, and then let's do it that way. So APAC, EMEA, and if we need to go back to page 19. It'd be interesting to see if they could give a breakdown of the average revenue per store to see who would have the stronger spending power. Because, I mean, my hunch would actually be would be Europe and the Middle East, but obviously Australia, South Korea, Hong Kong, Japan, Singapore. Well, all of these are very have affluent populations. But yeah, we'll do it like that, and then we can, as we get more information in the future, we can do it like that. So, okay, so APAC, let's say 610, we do equals 610.367 multiplied by 0.55. And EMEA, again, 610 multiplied by 0.45, and the weight is going to equal I need to lock it in. Yeah, that looks good, looks good. So, small Asia, 7.12%. It doesn't include Japan. Oh. It doesn't matter. I think that's fine. We'll go. Oh, but does it include Australia? Ah. Is there a better way we can do this? Okay, well this one's fine. 6.22% for EMEA. Whereas I do think this, because if you look at the countries where they have the stores, I mean they're all very the credit ratings are usually quite high. They're usually risk free. So I think it would actually be closer to. Well, let's see what Singapore's is by itself. Well, it's GDP weighted, so let's just use what 5.92. So we look at Singapore 4.21, Hong Kong was 5.1, Taiwan was 5.1, Japan is 5.25. But I think it'd be better than the global average, which is 5.88. Well, let's give it 5.1. Okay, now what we do, we need for all of them. So we need to go do the revenues. This isn't right, sorry. I've done China revenues all wrong. Apologies. 760,999. Hong Kong and 91738,917. Okay. Yeah. All good, all good. We go sum. So we have our revenues here. We want our weight. Let's copy these. Divided by 28. Again, lock in. And the ERP, we just put it to what we've calculated. We don't need anything there. Now we want the weight. No, this can't be right. Equals 4.58. There we go. So 4.82. That's what we get as the equity risk premium for Lululemon, which is about right because the majority of revenues coming from the US and North America, and the rest of the world is, I mean, at the moment it's quite trivial. Not trivial, but it's significantly not as important. Did I do this wrong? There we go. Okay, that's better. So equal. Okay, we just put, yeah, we put the equity risk premium to to this one here. I'll highlight that one so that it stands out. Now we use this formula to calculate the cost of equity. So the cost of equity equals the risk-free rate plus the beta multiplied by the equity risk premium. Which we go like that, and we have 7.74. Now we come back to our WACC, and we can put this equal to this. And because we've done all of that, let's get rid of the. There we go. Debt, cost of debt 0. So the WACC is going to equal. I mean, as we said, it's going to equal the cost of equity. But let's do it. I mean, let's do it as if we were going to do it, because when we update the spreadsheet one day, Lululemon could have taken on quite a bit of debt, and we would want it to just dynamically fill. So let's go. We want the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. And there we have it. There it is, 7.74% WACC. And in the next video, what we'll do is we'll actually build out the DCF for Lululemon. We have our WACC, and all we'll need to do is just do the revenue build. And the way I'll probably do it is, because there's multiple different ways we can do women's, men's accessories, or do we do company operated stores? No, I think we do it by women's, men's, and then the accessories and other categories. That's the best way to do it. Okay, cool. Well, thank you for listening. I hope you enjoyed it, and I'll see you when we actually build out the DCF. Thanks for listening. Bye.